We will quickly talk about moving averages and volumes and RSI. So volumes are basically number of trades that take place in a trading session. So these are usually in lakhs, and so let's say one X sells 30 shares and Y buys those 30 shares. So total volume here is 300, not 600. Okay, because only 300 shares are exchanged, and this information can be easily depicted with the help of bars at the just below the candles. So something like this. So these are all candles, and you can see at the bottom there's a volume. Okay, so these are the number of shares which are sold in a day. Okay, so if volume is huge, okay, something like this. So if you just notice this particular volume, okay, it is of this candle. You can see there was very strong movement in this particular script on this particular day with very significant high volume. But if you notice, there's a very strong shadow that is created. It did not breach the this resistance level. The stock came below the resistance level again, and it continued like this. But because there was huge volume, what we can easily understand is at from the high there was a very strong sell signal, and the stock corrected very rapidly. Similarly, if you see this particular volume, and you can see that maybe this is the candle that is being depicted by that volume, and it has breached this support level, okay, with very high volume. And that is the reason there was more and more buying. Okay, so if the morubuzu or the breakout is supported by very strong volume, that basically tells that the trend is going to continue. Okay, so volume plays very important role in terms of trend reversals or continuation of a trend, or very important aspect of technical analysis is the moving average. So MA is called as simple moving average. So it is average of last X prices. Okay, so let's say I'm going to talk about moving average of 3 days. So we call it as 3 SMA, simple moving average. So 3 SMA or SMA 3, and let's say you have three price points. So let's say 10, 15 and 20 as price points. So MA of 3 days of this particular close would be 15. Okay, now when you talk about 10-day moving average, so 10-day moving average is average of last 10 values. Okay, and it will continue. So let's say here, let's say we have next trading day, and the candle closes as 20. Okay, so this is your actual candle, and this is your SMA 20. So this SMA 3, so this SMA value is average of these three, and then the next SMA would be average of these three values. Okay, so next value would be 55 divided by 3, whatever the number comes, maybe let's say 17.5. That would be the next moving average value. Okay, and that is this because these are single values. So on your chart, something like this. Okay, let's say it is your chart. These are let's assume these are candles. So your moving average would be something like this. Okay, let me just try to draw over here in this chart. So we don't have any moving average over here. So your moving average would be something like this, a line, something like this. Okay, so this is average of closing prices. Okay, so if you see that when the current market price goes below moving average, that is a bearish signal. We can see that there is a stiff correction that is happening. And when prices go above moving average, so those are strong signals that the people are ready to pay higher prices than the average price. Okay, but let's say your moving average line itself is like this. Okay, it's going down and down and down, which means that your candlesticks are also going down. They are correcting a bit, but eventually whenever they are coming to the uh, you know average prices, there is more and more selling coming every time. Okay. Similarly, when the prices go above moving averages, okay, something like this, and whenever they are coming, so your moving average will start going up like this because there is a buying now. And every time when the stock prices are coming near to moving averages, there will be sudden buying interest, because everybody would want to buy because they think that the price are closer to the average prices now. Okay. So commonly used, moving averages are 10-day moving average. I prefer to use 30-day moving average, then 50 and 200. So 200 is basically, year of, last 200. So it basically takes care of a year of prices. 50 is basically a quarter, okay, because we have Saturday, Sunday as a holiday in between. And then 20 becomes in a way as a monthly time frame. Okay, so because it is taking average of last 20. Now there are expert traders like Peter, who basically use 18 instead of 20. Some people, some trader use 40 instead of 50. Okay, some would use 190 as 190 over 200 because they want early signal in terms of doing their in terms of arriving at a decision at early stages. So you can customize moving average the way you want. Apart from simple moving average, there is something called as exponential moving average, but it is just a type of moving average. For my study, I use a simple moving average because my most of the trades are positional trades. But in case you are going to go ahead with your intraday, so in that case I'll suggest you to use EMA instead of SMA. On Apart from the last candle, there won't be any much significant difference, but because you're going to work on, let's say, smaller time scales of 5 minutes to 10 minutes, in those cases it's better to use EMA. Okay. So as a general rule, we buy near to moving average, okay, and we exit below moving average. And it doesn't has to be very hard and hard rule that the now the price has gone below, I must exit. You need to take care of overall patterns as well, what your you know candles are telling you, what are the volumes of your each candle. So if prices are going below a moving average but there is no significant volume, so you can still continue with the trade with marginal risk, and you can put your stop loss order that even maybe you're going to take additional risk of a 1% or 2, and you can continue with the trend. But this has to be based on study. We cannot have hope as a strategy that the stock prices, though it has gone below moving averages, it is going to continue up. Okay, so there has to be some level of study, either on the basis of multiple candlesticks, or some underlying pattern, or at least some support levels, or we can also check what are the volumes telling me, and based on that we can decide whether to continue with the trend or not. Important thing is, when you have multiple moving averages, you can have let's say 50 or 200-day as the moving average on your charts. And let's say this is your 50-day moving average, and let's say this is your 200 moving day average. Now when the 50-day moving average crosses or does a crossover on your 200-day moving average from top to bottom, okay, so this term is called as the golden crossover. Okay, just another fancy name given to the study, but this is usually a bullish sign. So you can also have your 20-day moving average doing a crossover on a 50-day moving average like this from bottom to up. So this again becomes a bullish sign. Similarly, let's say you have your 50-day moving average and a 20-day moving average, okay, which was traveling like this, crossovers 50-day moving average from top to bottom like this. Okay, so this becomes bearish sign. So what is this telling? That my 20-day moving average is doing a crossover on my 50-day moving average from top to bottom. So this particular phenomena specifically in 200 and 50-day moving average. It's called as death cross. Okay, so this is a bearish sign. Okay, so on the charts you can see that this particular red line is my 200-day moving average. This is my 50-day moving average. So you can notice here that once the stock prices go below 250-day moving average, you can see that there is a tremendous amount of selling pressure that comes in, and stock might correct very rapidly. On the reversals, you can see that the once the prices goes above 50-day moving average, you can see that there was a very strong buying interest that came in. But after a mild correction, whenever the prices are touching the 50-day moving average, there was again a buying interest. Okay, you can also see that when the prices are going near to 200 moving average, there was again a selling pressure. So in a way, moving averages are also acting as a support and resistance levels. So here 200 moving into average is acting as a resistance. The correction comes, but again 50-day moving average is acting as a support over here. And again there is a buying interest over here. Again you can see there was a surge in prices. There is a breakaway gap created over here. There was a selling, but price did not came below this level. Now because this distance between support and resistance is narrowing, you can see that after a point a breakout will come, and the prices will eventually go a little bit sideways. You can see over here a golden cross is also done. And once finally prices come near 50-day moving average, you can see another breakout that came in. Okay, so now 50-day moving average becomes a very strong support. All right, so just last two slides we'll quickly cover. And there are a lot of indicators. There are almost 2000 to 3000 indicators. More and more indicators are being added by trading fraternity. But all the indicators, those are either leading indicators or those are lagging indicators. Okay, so technically there is no point of using lagging indicators, because lagging indicators are based on all the prices of your scripts. And because those are lagging indicators, so they will give you sell signals or buy signals when the actual move has already happened. Okay, so lagging indicators are basically used to confirm existing trend. Okay, whether the trend is going to continue or not. More important is the leading indicators. It's basically signals possible direction of the stock before its actual move happened. But there are only two or three leading indicators which are widely used. One out of that is RSI indicator. It's basically an oscillator, and it basically gives you value between 0 to 100. And we'll just see that in a bit. So all indicators carry secondary data based on price action that has already happened. And understanding how indicators work is more important rather than just blindly using those indicators. Most expert traders, they don't use indicators at all, because for them primary information is more important than the secondary one. So primary information that we have is the actual price action that is depicted by candles. Okay, and though indicators are useful, they should ideally be used for study confirmation. So in this particular trading, we are not going to cover all the indicators, because I personally don't use any indicators at all apart from moving averages and RSI. So RSI also I rarely use in case I want to predict a certain move, in case I want to increase my position sizing. So RSI is very popular leading indicator. So as I said, it's an oscillator. So its value oscillates between 0 and 100. Okay. And when the RSI shows you value as 70, it is usually overbought position, wherein you should ideally be exiting your position. When it goes below 30, it is oversold position, where maybe you can assume to buy certain stocks, and especially if those are in uptrend only, of course. Because let's say the prices are committing every day, obviously the prices is always going to be below 30-day. So this is an indicator. Okay, it's just indicating whether you should buy or sell. Okay, but it has to be supported by volumes, moving averages, overall patterns, and the candlesticks. So this is a formula for RSI. I think we should not be discussing how this is getting calculated. You can just Google around it, and you can get an idea how RSI gets calculated. There's a specific reason I'm not explaining it here, because I really want you to understand how RSI gets calculated, and that is only when it will make sense for you to use this particular indicator or not. Okay. Yeah. Now this is the last slide, I guess. Yeah. And so why candles price action is more relevant than RSI or any other indicators? We'll quickly check. So this chart is of CDSL. I think we took this trade around 350 rupees somewhere here, I think. Okay. And you can see that after this, the stock has moved significantly. Okay. And it created these huge volumes. Okay. You can see huge volumes. You can also see that RSI at the bottom here has been above 70. Okay, so now we say that above 70 it is an overbought zone, but you can see that it has you know reached to a same level, even though the stock has made its more significant move here. Okay, so if you just check that at this particular candle, it gave this signal that it's at a overbought zone. Okay, so almost touching 90 as the value. Then based on this, what should we do? Should we sell our position over here? The answer is no. You can see that RSI is moving in this range from 70 to 85, I guess, and it is making these higher highs. Okay, and even at this level, or even at this level, you can see that the RSI is giving incorrect signals at the bottom. Okay, so what the candlesticks and volumes are telling is more important than the indicator itself. Okay, using indicators makes more sense when you see some underlying information, like okay, this is also showing me an uptrend. Okay, so RSI is supporting, volumes are also supporting, the trend is also supporting that the stock is going to go up. So it is just a supporting signal. It should be used just for the confirmation, nothing else. Okay, so as a study, I use candlesticks, moving averages, volume as my primary study. I use supports and resistance levels based on tops and bottoms that stocks are making, and RSI as so support and resistance for all the tops that the stock has been making. So if we just check over here, so this would be support levels. You can see that the stock took some time to go above this level. Once it goes above, a breakout comes and a new resistance and support will be formed. So important is individual stock movement in terms of prices. Then we have support and resistances, moving averages, volumes, and pay less and less importance to indicators. Okay, that was all about indicators, moving averages, volumes.